Good morning and welcome to another of the Off the Road series. I'm Laith Khalaf, Head of Investment Analysis at AJ Bell. Today I'm mainly going to be talking about markets, but also taking a look at some regulatory developments that are going on, and also a touch of crypto thrown in for good measure as well. So just looking at the broad picture at the moment, I think it's a pretty difficult time to be an investor at the moment. There's lots of change going on, lots of things that investors need to chew over. Of course, you know, inflation's been the big story of the last few months, but we've got lots of other stuff going on as well. You know, the potential for interest rate rises, how that's going to affect markets. We've also got you know, high stock valuations in some areas of the market, but at the same time, you know, the economy is growing, and there's the big question of you know, where else are you going to put your money if not the stock market? So we're going to touch on some of those issues as we move through today. What I'm probably just going to start with is just a recap of how markets have performed over the course of 21, just to set the scene. So, I mean, if we just start off with looking at an asset class level. So, you know, I think we can see from this chart, it was again a pretty good year to be invested in equities. Your typical global equity fund returned around 15%, so pretty good return for investors. Property sector also had a pretty decent year, and both of those really, I think, built on kind of, you know, vaccine optimism, which we saw at the beginning of the year, and obviously the effect that has on the global economy. At the kind of bottom end of proceedings, you can see that it wasn't a very positive year for bonds, and that's of course because we saw rising inflation and also expectations of interest rate rises coming through as well. So I think most people hold bonds as a diversifier from equity. So in a year when, you know, your global equity portfolio has done 15%, it's probably not the total disaster if your gilt fund has done minus 7%. And you can probably see that from the mixed investment 20 to 60% shares sector here, which I put on there. So kind of a blend of equity and bonds, and you can see that that's returned around 5% over the year. So you know, looking forward, I think things could remain, of course, challenging from bonds. We've seen a bit more of a sell-off in the first few weeks of 2022. You know, unemployment is low. And you know, we've got sustained inflation, so that probably means that we're going to get a fair few interest rate rises this year, and that's not particularly positive for fixed interest markets. Finally, just looking at cash, which on this chart is basically the x-axis because it's going nowhere very fast. So again, zero return, minus 5% return actually if you factor in inflation during 2021. And although interest rates are rising, and they're likely to rise further, it's probably going to continue to be a pretty grim year for cash savers, because inflation, of course, is rising by more. So, you know, some expectations for inflation now coming in at 7% for the spring of this year. So, you know, interest rate rises probably gobbled up by cash savers, but they're not really going to put a hand on inflationary increases, unfortunately. So let's have a little bit of a dig down more into kind of regional equity markets. So we can see here 2021, the winner once again was the US equity market, with Japan bringing up the rear because fairly slow vaccine rollout and kind of prolonged economic restrictions. What's probably different about this chart to previous years is how well the UK has done. You know, it's kind of up there mixing it with the US, you know, not too far behind, which is you know, really something that's fairly new, kind of, if you look at recent history. And a lot of that was obviously driven by more money flowing into sort of more economically sensitive areas of the market, with the UK obviously having quite a high weighting to those. Interestingly, though, despite that, you know, rotation towards kind of what are known as value stocks, economically sensitive stocks, the US and that secular growth and tech story still won the day. And I think there's another way that you can look at this rather than looking just at regional equity markets, and that's looking at the kind of different styles of investment which we can do here. So I mean, they're broadly speaking, four different investment styles. So there's growth, which is investing in companies where their profits are rising. Momentum, investing in companies where share price is going up. There's quality, investing in financially strong companies. And then there's value, which is investing in companies that are cheap. And there are various metrics that feed into each one, but happily, MSCI compile indices of each of these investing styles. And if we look over at 2021 on the far right hand side there, what's interesting is how value is done. So value had a good year, particularly if you compare it to the kind of previous 5 years. And as we know, there was that value rally. I think it's important to keep that in perspective, though. If you look at the other kind of factors, actually, value was beaten by quality, and actually was kind of par for par with growth. So although it was a good year for value, it was also a good year for growth and for quality stocks. Momentum stocks may be a little bit behind. I mean, still a very, very positive year in absolute terms, but I guess momentum fell behind because some of the big share price rises in the market were driven by stocks that hadn't been doing well before, rather than stocks that had been going up sort of relentlessly. So I think that kind of helps to put the value rally in a bit of perspective, and I think part of the reason why quality and growth did very well over 2021 is that they still contain a large amount of US tech. The US tech sector is abundantly present in those indices because those tech stocks exhibit both quality and growth characteristics. Now, it's not just in those indices, but in the broader indices that actually the tech stocks are kind of playing a major part. Now, this is the S&P 500, the percentage of the S&P 500 that is held in FANGs, which is the orange line. So the FANGs is probably a bit of an outdated a moniker because there's been a couple of name changes, and we've also thrown Microsoft in here. So what you've got here is Facebook, Apple, Amazon, Netflix, Alphabet, and Microsoft. So you can see that a whopping $8 trillion market cap, and also now making up 20% of the S&P 500, the main index in America. Now, you might think, well, I don't invest a lot in American funds, so I don't have a lot of tech risk. But then just take a look at this. I mean, this is the MSCI World Index, and now almost 70% of that index is made up by the US stock market. So if you're invested in a global fund, you're probably going to have a fair amount of US exposure, and by extension, a fair amount of tech exposure as well. And that's also important if we look at where the money has been going recently. If we follow the money, these are data from the Investment Association. So this was to November, from the 2021, the year until November. And what you can see is that there was a huge outflow from the UK. That's not something new. That's been going on for more than 5 years now. And again, a big inflow into the global sector. And again, that's not particularly new. But that tells us there's a lot of money going into these global funds, even here in the UK. So, there's a lot riding on the US stock market, and by extension, the US technology sector, not just in the US, but over here as well amongst UK investors. So, what we're going to do now is just to take a look at some, the S&P 500, the American market particularly, and looking at the tech stocks particularly. So the main market, S&P 500, you can see here, it's been one heck of an ascent. The market's actually currently 50% higher than it was just before the pandemic. And then kind of, if you just step back a minute and just think about where we've been, we kind of fell into a hole with the pandemic, and we're kind of just really climbing our way out. On the face of it, a 50% rise in the stock market doesn't make a huge amount of sense. I think if you kind of dig down a little bit, you can find some justification for share price rises. So I think there is some substance to why the American market has done so well, but there is also an element of froth as well, as hopefully we'll see in the next couple of slides. So, looking at the reasons for why the stock market might have gone up so much, we can look at US economic performance. Good news is the US economy is now performing better than it was pre-pandemic after a big dip, of course. But you can see from this chart probably not so much that you'd expect a 50% rise in the stock market on the back of it. Things change a little bit though if we look not just at the economy as a whole, but at corporate profitability. So this is an index of US earnings compiled by US economist Robert Shiller. We can see here that there's actually been a fairly big increase in corporate earnings. Corporate earnings are 25% higher now than they were before the pandemic, and a lot of that is to do with the tech sector actually, earnings increasing as we'll see in a moment. So, I mean, what that tells us is that there is some substance there. The earnings have risen by 25%. The stock market though has risen by 50%, and the slack is being taken up by market valuations, by stock market valuations, and this is where the picture starts to look a little bit less rosy. Now, this is a chart of the Shiller CAPE ratio, again put together by Robert Shiller. The CAPE ratio being the cyclically adjusted PE ratio, which is the blue line on this chart, and also the left-hand scale. So what this looks at is the price of the market currently, and then compares that with the earnings of all the companies within the market, an average over the last 10 years. So it's like a normal PE ratio. Normal PE ratio will take the price of a stock divided by earnings over the last year. This is saying what about over the last 10 years, in order to give a more rounded view, and also kind of zone out some of the peaks and troughs you get in sort of prices and earnings year to year. So you can see from the blue line here, fairly elevated CAPE ratio. In fact, the CAPE ratio has only once been higher than its present level, and that was during the dot-com boom of the late 90s, and many of us will remember what happened after that. You can also see another spike over on the left-hand side of the chart. That was the 20s boom, which culminated in the 1929 Wall Street crash. So a little bit of a pattern there. When this CAPE ratio has been tight as it is now, bad things have subsequently happened. Now, I guess the argument against that is that we are currently going through a technological revolution. Wide-scale changes, like the scale of which hasn't been seen since the Industrial Revolution of the 18th and 19th century. That may well be the case. I think probably for me, if you take a look at the orange line on this chart, what you can see from that is the 10-year returns from the stock market in the 10 years after each CAPE reading. So you can see that there's a fairly strong inverse correlation there. So, when the CAPE ratio is high, returns from the stock market in the following 10 years have been low, and vice versa. So I think, this is pure historical data. It's over a long period. So I think, the idea that we are in this kind of technological revolution, that should mean that we've got more growth, and so valuation should be higher. I think that case deserves to be heard, but I think this chart here puts the burden of proof onto anyone making that claim. Essentially, they're saying this time is different, and actually looking at this, I think for me this is kind of one of the scariest charts about global markets that you can see, because it suggests 10-year returns from now on are not going to be particularly pretty. So let's kind of zoom in on one particular company within the market. So rather than looking at the broad market, let's look at a particular example, and why not look at the biggest company the world has ever known, Apple. So recently went through the $3 trillion mark in terms of its market capitalization. I think you can see from this chart, how astonishing the ascent has been. If you looked at this chart and it was, a really small growth company on the AIM market that done fantastically well, you'd be a bit flabbergasted. But for this, this is a multi-billion-pound tech behemoth. The speed with which it's gone through the gears from 1 trillion to 2 trillion to 3 trillion, that in itself, is frightening and perhaps a warning signal. Again, if you look down into what's going on at a company level, you can see a bit of justification for share price rise and also a bit of froth. So, if we look at Apple's profits, we can see that in 2021, the profits jumped around 60%. Had a good pandemic, like a lot of the tech stocks. All of us were inside. We're looking at our phones. We're looking at our computer screens. We're not going outside and doing normal stuff. So tech profits were largely boosted by that phenomenon. So we can see, there's been a very big jump in profits. So that should feed through into a big rise in the share price. I think what's also interesting on this chart is the orange bars on the right hand side, and these are analyst estimates for the coming years. So I mean, what's good news, if you're an Apple shareholder, is that analysts are expecting Apple to hold on to those profit gains, but they're not really expecting them to grow a huge amount. So over the next 3 years, we're looking at growth of around 5% total. So that's not a huge amount of growth that's penciled in for the next few years, obviously after a very bumpy year. But if we look at the valuation of Apple shares next, you can see that actually they're trading at their highest level in the last 10 years, at over 30 times forward earnings. Now, the PE ratio already takes into account higher earnings, so it really should be a measure of what expectations are from here forward. As we saw, analyst expectations are not that great. So again, kind of looking at this, what we could probably say from those charts is, yeah, there is some substance here in terms of the earnings increases, but there's also quite a bit of froth as well, with that big increase in valuations, with a fairly sort of minimal growth runway expected from here. Quick note on the world's best investor, Warren Buffett. I will be very happy with the Apple share price increase. So he bought, within Berkshire Hathaway, his investment vehicle, bought Apple shares between 2016 and 18 for $36 billion. The latest count was worth $130 billion, so pretty nice increase for Mr. Buffett there. What will be really interesting to see is what he does from now. Warren Buffett, of course, very well known for being a long-term investor. His favorite holding period, he says, is forever. So will he be tempted to sell down Apple shares simply because they've done so well in such a short space of time? I think the next Berkshire Hathaway accounts are around in February, so interesting one to keep an eye out for there. So that's a bit about the kind of market and a delve into one of the tech stocks. Thought it might be useful just to have a think about the sort of macro background for equities as well. Obviously, one of the things that's been very helpful for equity valuations and tech valuations over the last 10 years is low interest rates. And that is now beginning to change. So you can see that the US 10-year bond has been rising over the last year. So this is the US Treasury bond, the equivalent of our gilts. It's now just over 1.5%, so roughly where it was pre-pandemic. Still very low, of course, but on the rise, and with interest rates kind of predicted to go, kind of pick up more, we can probably expect that to rise further. Now, I suspect many of you have probably heard how rising interest rates are bad news for the equity market, and particularly for the jam tomorrow stocks, very high growth stocks, where they're maybe not profitable right now, but are expected to be in the future. And I just wanted to very quickly run through an example of the kind of discounted cash flow analysis that really kind of underpins that thinking. So apologies to you, or to those of you who are already familiar with discounted cash flow analysis. I'll be very brief, but just thought it'd be useful for those who aren't, just to kind of give you a flavour of how it works and how that might affect market thinking. So Basically, I guess the concept comes down to the kind of the value of money. Particularly the value of money over time. So if we look at this kind of example, we've got a company here that's paying out £1,000 of annual profit to investors. Not a huge amount of profit, but it makes our example simple. So if you'll bear with me on that front, it's not a company that's growing at all. It's not shrinking. It's just paying out £1,000 every year from now until 2030. So the question kind of the discounted cash flow analysis asks is, how should we view the value of the £1,000 that the company is giving us now compared to the £1,000 in 2030? Now, I think intuitively, most of us would say, well, actually, I'd rather have the £1,000 now, and that's more valuable than the £1,000 in 2030. But how do we actually kind of put a value on that? Well, I guess one way of looking at it is, well, if I got that £1,000 now from this company, I can actually invest that in other stuff, maybe government bonds, and in 2030, it will be worth more than £1,000. So actually, it's more valuable to have that money now, and we can actually kind of turn that thinking on its head and say, well, okay. Well, in order to get the same £1,000 that this company is going to give me in 2030, how much would I need now if I could, invest that without taking any risk between now and then? And that will give us, the current value of that £1,000 that's coming down the line in 2030. So we do that using the return on a risk-free asset, which would normally you would look to the government bond market. So what we've got here is an example of what would happen in terms of discounting that cash flow back to the present at a 1% interest rate. So you can see, if I can roll my money up at 1% a year without taking any risk, then that £1,000 in 2030 is worth £923 today. So I'd have to put £923 away. 1% every year, I'll have the same £1,000. So those two are equivalent. What's interesting is that you can see that if the risk-free rate increases to 5%, then suddenly that £1,000 is not worth £923 today, it's worth £677 today, because again, I can put my money away risk-free, and that's what it compounds at. So if you're looking at this company, nothing's changed necessarily in this company, but your view of what you should pay for it might well have changed if the risk-free rate has increased. And we can see kind of at the bottom there, if you total up all the cash flows from this company, you can see that the risk-free rate in this example, moving from 1% to 5%, actually changes the value of those cash flows by 14%. So far, so good. That's a company that's not experiencing any growth. And then let's just quickly have a look at an example of a different kind of company. So a company that's currently not making any profits, but it's going to grow exponentially. So it is going to have profits growing, doubling every year until 2030. So we could see a similar phenomenon here, that the more distant cash flows, if they're being discounted back by a higher risk-free rate, they're worth less. But what's interesting in this example is if you tot up all the values of the cash flows of the next 10 years, then actually the difference between discounting them at a risk-free rate of 1% and discounting them at a risk-free rate of 5% is actually 24%. So actually, if you're looking at this company, you say the value of this company, the value of the cash flows of this company will be 24% lower if the risk-free rate is 5% rather than 1%. And that's simply because the cash flows are backloaded at the back end of our period, so they're being discounted more. So that explains why when the market is looking at rising interest rates, it's thinking about some of these growth companies and reining in their valuations, and we've seen that happening particularly in the last few weeks, actually, with some of the growthier areas of the market. So your kind of ARC ETFs, even the Scottish Mortgage Investment Trust, some of the stocks held within that. So hopefully that's given you just a quick flavour of how the market might view rising interest rates and why that might affect valuations. If we just go back to our chart of the 10-year bond yield, you can see that obviously there's been a big rise since the yield bottomed out when the pandemic pandemic hit. And also, you know, looking forward from here, there's still plenty of scope for interest rates to rise. So that could potentially be, you know, a headwind for equity market valuations. What's also interesting from this chart is that there is already within it a period, as you can see, between July 2016 and November 2018, when US interest rates were actually rising, you know, in a fairly sustained way for a reasonable period of time. So we can maybe look back at that and say, well, what happened to the market then, you know, as a kind of blueprint for, you know, what might happen this time. And actually, the answer to that is the market did really well during that period. Now, there were a couple of things happening at the time that explained that. The first was that the US economy was performing very well. And, you know, that was why the central bank was hiking interest rates, because it thought the economy could sustain it. And actually, that's the same this time around. That's you know, the basis on which central banks are going to be raising interest rates. The other thing that happened during this period is there was this historical figure. Some of you may remember him. He's called Donald Trump. May not be a historical figure for too much longer, but at the time when he was in office, he actually enacted some pretty extensive tax cuts for individuals and for companies, and that helped boost the market as well. So I think things have probably moved on from here, because valuations in some of the market have moved higher. So probably the stakes are higher in terms of you know, that kind of discounted cash flow analysis and what interest rates might mean for valuations. But I mean, this chart does show us and remind us that that kind of valuation analysis is not the only game in town. Other stuff can happen, which, you know, can be positive and can mean positive things for the market. So markets can still, you know, make progress even though interest rates are rising. So the other thing that I think is broadly positive for markets is where else you can put your money. In an environment where interest rates are rising and inflation is elevated, where are you going to put your money? Now, these are expectations of inflation from the OBR. They were actually given in October. I suspect that if they were given now, pretty sure they would be significantly higher, because actually, as I said, inflation is expected to come in at around 7% in the UK this spring. But, you know, even if you take these at face value, what you're facing over the next 5 years is inflation going up by 12%, and actually it's probably going to be more than that. So your starting point for investing is, I've got a headwind of minus 12% that I need to beat. So where do I put my money? So, you know, let's have a think about through the various options. Well, I've got bonds. Well, you know, if interest rates are rising and inflation's rising, that's not too good for the fixed income streams of bonds. So that doesn't sound like a particularly good idea. Could invest in cash. Well, you know, interest rates are going to be rising, but it's going to be some time before they're sort of a reasonable rate, and certainly, you know, anywhere near inflation. So that doesn't sound like too much of a good idea as a long-term investment either. Property, well, yeah, I mean, property does probably include some inflation protection. Probably you can think about how much of your portfolio, of diversified portfolio, would you realistically put into property. You know, 10%, 20% starts to feel a bit punchy. So, you know, maybe it's part of the solution, but not the whole solution. Also, with bearing in mind with property, obviously there are, you know, high charges and high taxes as well. And we've got this issue within UK open-ended property funds, where a lot of them are holding 20% cash for liquidity reasons. So actually a lot of your money isn't actually invested in property anyway. But, you know, potentially a partial solution. Gold. Well, again, realistically, is that going to be a major part of your portfolio? No, it's probably going to be a 5%, 10% position, so maybe part of the solution. I mean, you know, if you look at a gold chart and an inflation chart, there doesn't seem to be much resemblance between the two. So, you know, I'm not sure the data fully supports the idea that gold is an inflationary hedge. The other thing that we have to be aware of with gold is that rising interest rates, again, are not particularly helpful for gold. You know, if I've got this safe asset over here, which is, you know, the US Treasury bond, and it's paying me 0.5%, then actually it doesn't really cost me very much to hold gold. Gold doesn't pay an income, of course. So I could have 0.5% over here, or I could hold gold. Well, actually, okay, I'll hold gold because the opportunity cost is not that great. If suddenly this safe asset over here is yielding 2 or 3%, well, that sort of changes the dynamic. Maybe I'm not quite as comfortable holding gold because the hurdle rate that I've got to beat against the US government bonds is that much higher. So potentially a bit of a headwind for gold there. So, all of that kind of, all those roads kind of lead us really back to equities. And this is the same narrative that's been dominating markets for the last 10 years, really, which is, the kind of Tina scenario. There is no alternative. There may well be some rotation in market leadership. We may see some of the higher growth stocks give way to the more economically sensitive stocks, particularly in an area where we're expecting that economy is going to be kind of a rising tide that lifts all boats. But actually, kind of where else are you going to put your money to get a real return? It's probably still the stock market. So the eagle-eyed amongst you will have noticed that there's one very important asset class which I haven't touched on there, which is, of course, cryptocurrency. A burgeoning asset class, should we call it. So, this is how Bitcoin is done. I don't need to tell you how volatile Bitcoin is. I don't need to tell you that people who've held onto it for a long time have done really well. So £1,000 invested in Bitcoin 10 years ago. The end of 2021 would have been worth over £11 million. So a fair return on your assets there. There is kind of a story about a US computer programmer, one of the early Bitcoin adopters. It's called Laszlo Hanyecz. Look him up if you have a minute. So he spent $10,000 on 2 pizzas, which he paid for in Bitcoin. 10,000 Bitcoin for 2 pizzas, and that was in 2010. Those Bitcoin at the end of 2021 would have been worth over $300,000. So it's widely reported as the first cryptocurrency transaction. And we can only hope that he really enjoyed those pizzas, because what that tells us, I think, is that even as really early Bitcoin adopters didn't have any inkling of where Bitcoin was going to go. So I'm sure many of you are probably having conversations with clients around Bitcoin, clients who have heard about it, want to invest in it, maybe hold some of it, and it's probably quite difficult, I suspect, to say anything sensible about it, because the price is just so volatile and doesn't seem to kind of have any sort of rhyme or reason to it. But I think there are probably some sensible factors which feed into the price. Maybe just talk through a few of those. And these are the things that I think, in terms of kind of crypto, that you need to look out for. The first is business adoption. If businesses and consumers start to adopt crypto as a means of exchange between each other, and that strengthens the bull case for crypto. I think that has to happen in a meaningful way. So it can't be just a company saying we're going to accept payments in Bitcoin, and as soon as it gets them, converting them into pounds, dollars, and euros, because that's just a sales tactic. That isn't kind of a meaningful exchange. So it needs to happen in a meaningful way. I think there are strong reasons why that won't happen on a sort of a big scale, because crypto at the moment is so volatile. Businesses are not going to want to hold that stuff on their balance sheet. Businesses have bills to pay, like all of us, in pounds, in dollars, in euros, in yen. So they're not really going to want to hold something on the balance sheet which can fall 40% in value in a couple of weeks. So worth keeping an eye on, but for my money, that's probably one that might make some ground, but ultimately I don't think it's going to be particularly widely adopted unless crypto becomes much less volatile. New investment products might open up avenues for investment managers to invest in Bitcoin as a bit of an alternative, a digital gold, perhaps. I think probably, again, there are probably some reasons why asset managers probably might fear to tread into that arena. Again, the volatility is an issue. Also, the fact that there's not a huge amount of sort of regulatory rubber stamping on the underlying asset class. And also, in a world of ESG investing, the environmental impact of Bitcoin, and crypto generally, which we'll come on to in a moment. Regulatory activity is also important for the price of cryptocurrencies. We've seen kind of crackdowns in China and India have an impact on crypto prices, and it turns out that regulators generally across the board don't particularly like an asset class in the financial system that is potentially rife with money laundering. It can be used for scam activity, and that could lead to very large investor losses. And probably, particularly as crypto becomes more popular, more meshed in the financial system, I think we can probably expect regulators to sort of step in more and more. And actually, already we're 2 weeks into 2022, and the FCA has already cracked down on crypto adverts. So I think that's probably a headwind for crypto. Ultimately, it might be good that the crypto becomes more regulated, but it might not sustain the price that we see at the moment. Environmental concerns, as I said, Bitcoin has a very large electricity consumption footprint to mine the crypto. Analysis of Bitcoin suggests that total Bitcoin mining consumes the same amount of electricity as Argentina, which is a whole country. So in the world of ESG investing, that's clearly not a good thing. Interestingly, Tesla and Elon Musk, who's a bit of an unpredictable bellwether for this particular issue, last year, at the beginning of last year, said, hey, we're going to accept Bitcoin in payment for cars, but then rode back pretty quickly saying, actually, we're not going to do that until cryptocurrency somehow moves to more renewable sources of energy. And that is beginning to happen. So we might see some movement on that front. It could swing either way, and probably keep an eye on Elon Musk's Twitter feed for that one. And finally, central banks are either launching or thinking about launching their own digital currencies. We are in the UK now as well. Bank of England is thinking about it. That wouldn't be a different currency. It's still the pound, but it's a digital version. And that potentially usurps some of the benefits that are seen for cryptocurrencies. So, speed of transactions, cross-border transactions, potentially the cost of transactions. So, that maybe undermines the case for cryptocurrency. I think probably cryptos will still, maintain that sort of anti-establishment appeal for some people, but ultimately, when push comes to shove, I'd probably think people want their money to be safe, rather than using it to stick 2 fingers up to the authorities. There are other cheaper ways to do that probably. So hopefully some thoughts there that maybe you can help you with conversations you might be having with clients. Just to kind of round up, really, I thought it'd be just useful to have a look at some of the regulatory and tax developments that are coming down the road at us, just to keep an eye out for. So the FCA is looking at a green labeling regime for ESG funds. I think that would be really, really helpful, help us with some of the kind of mess that we've got, because I think there are lots of funds out there that are saying, we take into account ESG considerations, which I'm sure they do, but the resulting portfolio is probably not what your sort of everyday investor would think of as an ESG portfolio. So tough nut to crack, but one the FCA is taking on, which I think is a positive thing. We're still waiting for what the FCA is doing on property funds, whether they're going to introduce mandatory notice periods of 90 to 180 days. I think that could potentially hit demand if they do, so probably quite critical for the sector, and still one we're waiting for. The FCA is also looking at introducing default funds for individual pension funds. So default funds, of course, used in the workplace. The FCA now saying, if you're applying for a SIP or an individual pension, then we think that you should be offered a default fund as well. So I'm not fully convinced why they're doing this, but they are doing it. It's not going to work. It's not going to apply to advisory clients. So you guys are off the hook for the moment, but it's worth being aware of, because I think it's an interesting one taking place in the market. And then, of course, we've got tax thresholds going up not going up, tax going up, tax thresholds staying where they are because they've been frozen from this April. Obviously that feeds into the kind of whole cost of living crisis narrative, but also, of course, it's really important that kind of, if we pay more tax, those tax thresholds staying where they are, it's important that your clients are obviously kind of doing their tax planning, because we're all going to be paying more tax, unless that is, of course, in the budget. The Chancellor relents and probably pushes those tax rises off. Who knows? I guess it's possible. Who's even going to be the Chancellor when the budget comes around? Who's going to be the Prime Minister? We don't know. Politics is really unstable at the moment, so it's very difficult to call what's going to happen in the budget. I think looking at kind of the economics, whoever's giving the budget is not going to have a huge amount of room for manoeuvre. So there might be some moving around of stuff. But November's budget was a huge sort of £75 billion giveaway, and a lot of that came from ditching the state pension triple lock from the national insurance levy, which was announced before the budget, and also massive upgrades to the economic outlook from the OBR. We're not going to get those things this time around, so I suspect it's going to be a bit of a quieter budget, not so many sort of big unexpected things coming out, a more workmanlike probably budget with a bit of tinkering. So so it's relevant, of course, to end with a risk warning, but probably particularly when we'll be discussing crypto matters. So here's the compliance bit. That's it from me today. So I hope you found some of that vaguely interesting and also useful. Thank you very much for listening.